Let's take it to the top story then, Krishna, where we are analyzing the impact of that rework tax treaty with Mauritius on startups. Now, why are we doing this? It's because most of the venture capitalists and hedge funds who invest in Indian startups largely do it through entities that are either based in Mauritius or Singapore. So between yesterday and today, we've really been speaking to many people on, what this means, what this will entail. And to really break it down for us, we have one of India's most active angel investors. We are, of course, talking about Mohandas Pai from Manipal Global. Sir, thank you so much for joining us on ET Now Startup Central. As one of India's most active angel investors, someone who works with startups closely, what is your own assessment of the reworked tax treaty with Mauritius and what this means as far as startups are concerned?
I think it's a very good move by the government to bring in certainty in the law. We know for sure that over the past many years, despite the law being clear, the Income Tax Department was going after people using their discretion and trying to do all kinds of things to make sure they extort more money. Now that the government has said that we are going to have a very clear provision in the law that there will be a grandfathering scheme and there will be a slight discount to taxes for next 2 years, and after that, unless you are a Mauritius resident, in the sense money comes from Mauritius, not from anywhere else, you will be taxed as per the capital gains rules in India, and that removes an enormous amount of arbitrage and uncertainty. And I think that's very good news because we find more and more funds going through Singapore. We find many funds coming to India directly because they're fed up of this tax uncertainty. So I think it's very good, and also it removes a major distortion from the Indian point of view, local residents' point of view, who have been very complaining that they are treated like a stepmotherly manner, and I think that lose the irritant, and our local mutual funds and overseas mutual funds are put at the same level. But Chandra, one important thing that's required is the fact that we need to relook our tax rules to make sure that if an overseas investor makes capital gains, not more than 1 year, because after 1 year is tax free, less than 1 year, then in that case, the exchange difference, that is, the tax is paid on the dollar value of the money bought in, not the rupee value. Because if there has been a rupee value depreciation and he gets more rupees, but in dollars is the same, he'll be paying taxes out of capital. So I think to that extent, there has to be some revision of the tax law, which I hope the government of India will do.
Mr. Pai, this is Krishna Kumar coming to you from ET Now's Mumbai studios. I wanted to ask you, but won't this impact startups negatively, considering a majority of investments by venture capitalists and hedge funds are routed via entities in Mauritius?
Well, definitely for startup investment, the existing capital gain exemption to Mauritius entities will go, and if they don't get the money from Mauritius, then if they invest in startups beyond 2 years of sale, they still have to pay the 20% tax subject to indexation. And I think if they get the benefit of being accounted in dollars, like I said earlier, that their profits are accounted dollar to dollar and they get that exemption, I think it's applicable in some other cases, then I think they're okay. But the taxes they have to pay not coming through Mauritius, because the new law will be higher in future. So there will be some impact, but I guess they have to learn to live with it, because they will enjoy the indexation benefit, and the indexation benefit may not substitute fully for the tax holiday benefit that Mauritius offers. But I think many of the funds are coming to Singapore too. So I guess the system has to grow up, the system has to mature, we become a larger place for FDI and everything else, and venture and the startup funding should be in the same nature as FDI. So I think there'll be a hit, but I guess people have to learn to live with it.
All right, Mr. Pai, in the US, if you are, you don't have to pay taxes for your capital gains over there. You're only taxed here in India. That's how much of how the West operates. So you invest in that country and it's not taxed there. Why should India then be different?
Well, I think in the US, you will have a direct country-to-country double taxation treaty. Now look at what happens in India. There's a US investor, US-India have a double taxation treaty, and that says that the tax gains of a US resident will be taxable in the United States, But what the US investor does is go to Mauritius, becomes a Mauritius resident, and from Mauritius invests into India. So the tax treaty that applies is Mauritius to India, not US to India, despite the money coming from the US. By creating an entity in Mauritius, the benefits of no capital gains in Mauritius comes to him. Now the tax laws say that if your US money going to Mauritius, then Indian law will apply. But if your US money coming directly to India, then you will have to comply with US law or whatever the double taxation treaty between India and the US says. So I think this is a much better, because this reduces, let us say, TT shopping, what is called TT shopping. And TT shopping is now going to become less because of BEPS, the base erosion and profit scheme. I think it's going to become less because OECD is coming with certain norms. And I think this is a part of the cleanup exercise globally in international tax.
Mr. Pai, from what we understand, when VCs invest in startups, it mostly happens in the form of preference shares, because preference shares entail extra rights. But with this coming in, again, will they have to be structured differently, converted into common shares before getting an exit? What kind of changes need to be done as far as structure is concerned of these investments?
Chandra, in the budget, the government has amended the law to say if you have a preferred stock or a convertible instrument, the date of original investment for capital gain purposes will be the date of the purchase or investment in this instrument, despite the conversion happening later. So it goes back. I think it's very good, because that's been there's clarity on this scheme now, is applicable to all convertible instruments. That's very good news. So I think the issue of tax structuring comes down substantially right now if you have a convertible instrument, because that is a gray area. And I think the second issue about any kind of restructuring is if they use very complex structures, they all will be grandfathered. Please remember, all investments coming to Mauritius till 31st of March 2017 will be grandfathered, and from 17 to 19 any investment made will have to pay 50% of the tax they would have to pay otherwise, and that's a good concession. So the real impact comes from 2019. So everything done this year up to this year end will go by the earlier law. So I think it's a very good measure, so all the people who already invested don't have to worry.
All right, Mr. Pai, I have one last question to ask you before we let you go. Startups getting domiciled outside India was also an issue, both for business and tax reasons. Will that attractiveness then come down now as a result of this particular agreement?
Yes, I think the domicile issue will be addressed substantially because of this. Domicile happens for strategic regions, domicile happens for business reasons, and happens for tax reasons. The tax reasons become less compelling because of the way the treaties are going to be structured. The strategic reasons remain, and that's what India needs to address. And the strategic reasons have got to do with M&A transactions too. That M&A in India is still complex under foreign exchange laws, and now the RBI has come out with certain norms for escrow and all that, which is improvement, but little bit more needs to be done. Our listing regulations are very, very good, but I think they're asking for a bit more, which hopefully should get done. And these two will remove some of the strategic reasons. So if 100 is the base, now I think with the listing getting improved, hopefully the forex getting improved and the tax clarity coming, the 100 reason would come down to maybe 50 or 60, and that is entirely business-led. And I think that business-led will remain because if IP and everything is necessary for sale in the United States or elsewhere where people feel more comfortable, or they require some particular kind of structuring, that will remain. But I understand what you're saying, and I think this will improve matters for the next few years.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.